Hi. Okay. This episode, I'd like to talk about financial reform, and yeah, I know I've talked about this before, and I don't want to repeat everything that I talked about for a long time about banks and capitalism and globalization, corporations, multinationals, and a whole bunch of things. But um, now, what could you do in financial reform that would really make a difference? And I know they're calling this bill too big to fail, but they're not really doing anything to stop that. Too big to fail. What is too big? We haven't defined that. We haven't regulated what is too big to fail. What is, I mean, I know we have a Sherman Act for monopolies and stuff like that. But as far as healthcare is concerned, we haven't really applied that principle or that law into these companies. And when it comes to financial companies and banks and investment firms, you know, I kind of agree with banks being separated from investment companies because maybe banks shouldn't be dealing with that. I agree with that. But I also think that banks in general should have a cap. I mean, banks should have a limit, and all companies and loan companies should have a limit to how much they loan, what percentage they loan, and stuff like that. Now, when I say that the government is business friendly, I just don't mean it like that. I mean, we had credit card reform. Credit card reform was basically having the fine print of what all that fine print meant put in gold letters in the invoice. That's basically what our credit card reform was. What credit card reform failed to do was put a cap on the interest rates of how much you can charge. If if I invest $1,000 in a stock exchange and be guaranteed or not guaranteed or average out to a certain amount of money I can make a year. And if the credit card companies is charging more than that, it's nothing but a loan shark. It's like a mafia loan that's charging too much interest, too much money. And I had to say that because I was proud of the credit card reform. It did tell people what they were getting into. But it still is it's still a highway robbery. You can't charge those kind of interest rates. So credit card interest rates need a cap. They need a limit. And I think some of these what we really need to do is to find a loan to capital rate. A ratio for how much loans we give out and how much capital the banks actually have. We need that kind of a stable amount. And what that bailout did was basically make sure that the banks are still not just solvent but stable by increasing the amount of capital that they have. And then they started paying back some of the money. But it's been, it's just, I think that's the key regulation we need. I know that you're trying to say capitalism and market is high risk, high reward, and all that. But when does it come into just being predatory lending. Predatory lending, like payday loans, payday loan companies, and that kind of interest rates that they charge. And what's the difference between that and banks that have collateral to give out these loans and stuff? We need um, we need a federal guideline of how much the ratio of capital to loans there should be, and we need the people to read the fine print because there's not always going to. But what is the function of government? One of the functions of government, I think, is to protect the people. And to protect the people, we need consumer protection. And for that, we also need to have regulation of these banks. But look, if you're saying that we don't need regulation, we just want to make money and blah blah blah, let's face reality. Reality is no one can pay the rates that you're charging. No one can pay it. That's the reality. And Wall Street needs to realize that some of these great packages and great financial opportunities that they're giving to poor people and people who want a loan are just not payable. If you switch shoes and you put them into their shoes, they would never take the loan. They would never take the loan because the interest rates are too high and they're not payable. But they know that. They're giving it to you thinking that you're going to be able to pay it. I mean, they're thinking that you pay some of it, you'll be paying a minimum payment for the rest of your life. I mean, that's what they settled on, basically. Because when it comes to profits and just numbers and figures, profits and losses, they are willing to give you whatever you want as long as they can get a steady income from you for the rest of your life, whether it be the minimum payment or whatever. They're willing to do that, and it's come to that bottom line, and we need to take it back from there. We need to be in reality and try to find a cap for these interest rates, a cap for loans, a cap for loan to capital ratios. If we have a federal limit or a state or United States like cap on how much a bank can have before it can loan a certain amount, before it just starts competing with another bank and tries to make risky loans or whatever the way you want to look at it. So I don't think I was that clear in this episode, but you might get the right picture. I was trying to just say that it's just not realistic to expect uh, people who are taking out loans to pay back such high interest rates, especially when it comes to credit cards and some of the other stuff. It's just not reasonable. It's not realistic, and we need to put a stop to that because it might be uh, instant gratification as far as getting the loan through and showing it in your balance sheet as a loan and a future profit. But when it comes to paying off the profit, everyone defaults on paying out their loans and their credit card bills, and that piles up, and that ends up in the derivative in the future in the foreign market, and that ends up as a default, and that ends up as a written off bad debt, and that ends up as a loss, and that ends up as a loss of jobs, and that ends up as a loss of willingness to give credit. So we need to look into that.